Hi, welcome to this week's webinar, Paying Off Debt. My name is Susan Harlow, and I'm a certified financial coach at Coconino County Community Services. We're going to start off talking about credit scores and credit reports and what are the aspects that actually create the credit score. As you can see in this screen, payment history is the first category that lenders will look at to see if what ability you have to actually borrow money and pay it back. So your payment history is 35% of the actual score. So paying your payments on time is really, really important in regards to this aspect. The next category is amounts that are owed. Lenders look at amounts owed on accounts, how much is on those accounts, how much of the total credit line is being used, how much of the installment loan amount is still owed, and compared to the actual original loan amount. And that's what it means when amounts owed. The next category is length of credit history. So for people who have had credit for a longer period of time, that will influence their credit score in a much more positive way than maybe for a college student who's just getting out and just starting to develop their credit history. The next category is new credit. And in terms of new credit, what that means is how much credit do you actually have taken out? So, and is it mixed type of credit? So when getting new credit, you want to be able to get new credit cards within a 2-week time period. So if you're shopping around for new credit cards, trying to get a better interest, you want to actually do that within a 2-week time period. And that way, it looks at the credit agencies that you're actually just shopping for possibly one card rather than those applications being spread out over the year. So that's one thing to keep in mind when you're shopping for new credit. And then the different types of credit are credit cards, retail accounts, installment loans, mortgages. And they differ in multiple ways. Credit card is considered a revolving debt, so you're borrowing money and then paying it back, borrowing money and paying it back. An installment loan is like a car loan where you are maybe taking a 5 or 6 year loan out, and the same amount is being paid every month for those 5 or 6 years. And then a mortgage loan is a much higher dollar amount over a much longer time period. And that's what's considered as different credit. When you're looking at your score, this is kind of what the general, the rates are. And you can kind of see based on if you have good credit or poor credit and how that will affect you. Actually, your credit score is so necessary today. And the higher the score that you have, the better it will be because it impacts, if you're going for a loan, your interest rates on your credit cards, if you go for an apartment. What it's really showing a lender is your ability to be able to borrow money and pay it back. So if you wanted to increase your score, here is a couple of tips of how to do that. First of all, I would recommend getting your credit report, and you can get it at theannualcreditreport.com. All the agencies entitle you to one free credit report a year, and so you could either run all 3 of those at the same time and compare them, or you can spread it out like a quarter or so throughout the year. Why that's really valuable is because your credit report will list if you had any outstanding payments, if you've been late on any payments. It's going to really show a lender your ability to be able to borrow money and pay it back. But it's also going to show if there's any errors on there that credit agencies have reported that are affecting your score. So by reviewing your credit report, you'll be able to see if it's been just your actions or if it's been something erroneously put on there, which you can then send into the credit agencies to do an investigation on. Making your credit payments on time is probably the biggest ways to increase your score. So if you are behind or have stopped paying them, you want to try to get as current and stay current with those payments as quickly as you can. Also contacting creditors or to see a legitimate credit counselor if you're challenged with making your payments. Going to them first to try to work out a new payment plan is a really good idea, so that way you're not just ignoring the letters or the phone calls that are coming through, but you're actually trying to work with them to try to create something that is workable for your budget. Other ways that you can reduce the amount of debt you owe is by creating a plan. So paying off debt rather than moving it around. So a lot of times we get in the mail the free interest rate for the year. And a lot of people who have credit card debt will take a credit card limit that they have that has a higher interest rate and put it on the zero interest. And that actually will affect you in two different ways. One, you're actually opening up another credit card. So now they're considering that you have the potential of actually using that credit card and maxing it out. But it also is showing that you're not actually paying your debt down, but you're just moving it around. So the best way to actually increase your score is to create a plan to pay that debt down. When you're using your credit card, you want to try to keep your balances 25% or below the actual limit. The credit agencies do consider it against you, actually, the higher you use the limit and you keep it there. So it's one thing if you were to charge something on there and it's close to the limit and then pay it off. But when you actually are keeping a balance that's close to the limit is when it does affect you negatively. Don't close unused credit cards. That can actually backfire because, especially if you've had a lot of history with that particular credit card, you are receiving some benefit from that because you have history with that card, and that actually is a good thing. And then again, don't open a number of new credit cards that you don't need. So sometimes people will think, well, if I don't have any credit or my credit is bad, I'll open up some credit cards and that should increase my score. Actually, that doesn't, because again, opening up credit cards that you won't use and then having those potential limits to be able to charge off of actually works against you. They suggest that to have 2 credit cards is a really good amount of credit cards to have, and we're going to talk a little bit about how to use your credit card as a financial tool. The best situation to be in is if, when you're doing your budget, is that you actually have enough income to cover your expenses. And I know there can be times where you go to use your credit card to purchase things that are outside your budget. But unless you have a plan then to actually pay that debt down on that credit card, you're better off waiting and saving to purchase that item rather than using a credit card as a way to go above and beyond your budget. So how do you use a financial tool to increase your credit score? So we've talked about in all of these different webinars how to use a budget, right? And budgeting helps you to get it all written down. You can see very clearly how much income you have, what are your expenses. The best case scenario is that you have enough income to cover your expenses and that you're not using credit cards to live off of. Then the second step would be to make sure that you're staying and you're disciplined to stay within those budget lines, that you're not borrowing money from other categories or that you're not overspending in those categories. When you feel like you've really kind of accomplished that, and that's a big accomplishment when it comes to money and changing your behaviors and habits, then you could begin to use your credit card as a financial tool. And we're going to talk about how to do that. So let's say, for example, in a previous webinar, we were talking about the envelope system where you're putting cash in an envelope to pay for your gas for your car or for your groceries. How you could then begin to change and begin to use the credit card as a tool is that instead of using the cash to purchase those items, you would then go and swipe your credit card and use your credit card to purchase your gas or your groceries. And then you go home and then you're going to pay your credit card right away. So it's not like you're using your credit card or borrowing money to actually purchase these things because you already have it set aside. But you are using the credit cards to record that you're borrowing money and paying it off, borrowing money and paying it off, and that helps to increase your score. We're going to talk a little bit about creating debt on an intentional basis and the pros of actually creating debt. The first type of debt we have is secured debt, and secured debt is when you have an asset attached to it, such as a home or a car. Unsecured debt is debt that has no assets attached to it, such as a credit card or medical debt. There's not anything of value actually really attached to it. And when you're actually intentionally creating debt, one of the things you want to keep in mind is it going to create some type of asset for you? For example, if you were to go and take out a mortgage to purchase a house, the house is an asset, and over time, it increases in value. And therefore, you've taken a loan out to purchase an asset that's going to increase in value, and your asset is worth more. That is one reason why to use creating debt as a good vehicle for somebody in their financial portfolio. Another way is if you wanted to take a loan out to start your own business. That, again, is creating an asset that is going to be, that would help increase your income. And then thirdly, although there's a lot of conversations around student loans and how to keep them down, so that way you don't have a lot of debt when you get out of school. But taking a student loan out in some way is increasing your ability to be able to create more income for the future. And so that would be an example of creating debt for some future potential of increasing your income. Next, we're going to be talking about how to pay off your debt if you are trying to pay down like a lot of credit cards, or if you have student loans or car payments. There is this technique called the snowball effect, and I'm going to go through an example here of how you can use the snowball effect to systematically go down each of your debts and begin to pay these off. So for example, in this screen here, for this example, you have one credit card at $500 with a monthly payment of $25. You have a second credit card that has $1,000 owed on it with a monthly payment of $50. You have a car loan that is, you have $6,000 you owe on it and a payment of $135 a month. And then a student loan, the total amount owed on that is $15,000, and it's $159 a month. So when you begin to apply this snowball effect, what you're going to do is, let's say you've looked through your budget and you were able to find an extra $100 that you want to start applying to paying off your debt. And in this example, we're paying at least the minimum of all of the, whether it's a credit card debt, the car, or the student loan. You're paying at least the minimum, but we're going to take this extra $100 and begin to apply it to that first credit card. So in that first example here, we are paying $25 on that credit card, but now we have an additional $100 that we're going to pay. So we're going to be paying $125 towards that $500 balance. And you continue doing that each month while still paying the minimum on the second credit card, the car loan, and the student loan until the $500 is paid off. Once that first credit card is paid off, you're going to take that $100 plus the $25 you were applying towards that first credit card and now start applying it towards the second credit card. So you can see in this example, you would then be paying $175 a month towards the balance of the second credit card. And you continue doing that until that second credit card is paid off. And then you take all of that money from the first credit card you were using and the second credit card you were using and apply it towards your car. So you can see in the example, the $175 is the $100 plus the $25 from the first credit card, the $50 from the second credit card, plus the minimum that you were paying towards the car. So you're paying now $310 towards the car. When that is all, when the full amount of the car is paid off, you're now going to apply all of that towards the student loan. And you'll end up being able to pay $469 a month towards the student loan. And you can begin to see how not only will that help to build your confidence that you're able to pay your debt down, but with you continually increasing and using all of that money towards your debt and not taking it away, you can quickly begin to pay your debt off. Once you have paid all your debt down, the best case scenario would be that you would try to stay out of debt. And how you can do that is by staying within your budget, using your credit card as a financial tool to increase your score rather than living off of. For any big ticketed items, you want to be able to save your cash rather than taking out loans to purchase those. Again, not using your credit card to live off of. And looking for different ways to increase your income or lower your expenses or a combination of both. And then making sure that you pay off your credit cards on a timely basis. These are all great ways for you to begin to pay down your debt, be able to begin to free up some money to be able to save, and then also looking for other ways to increase your income and reduce your expenses so that you create a financial situation that you absolutely love. And this is how you begin to create the life that you really love, is by using your finances in a way that you feel empowered, reduces your stress, you have peace of mind, and all of these tools, as you use them over time, can create this for you. And thank you so much. This webinar is complete.